Hey everyone, welcome back to Corporate Decoder, where we decode the hidden stories within corporate filings. And let me tell you, today's story is about a company that is trying to raise some serious cash to keep the lights on, so buckle up. We are diving into a Form 8K filing from Ascent Solar Technologies Incorporated. Now, an 8K is basically a company's way of telling the public about any major event that shareholders should know about. And for Ascent Solar, the 5th of December 2025 was definitely a big day. So what happened on the 5th of December 2025? Well, Ascent Solar, the company, entered into a purchase agreement for what they call a private placement. Think of it as selling shares and other rights directly to a select group of investors rather than on the open market. This isn't just a simple stock sale, however. They're not just selling common stock, they are also selling these things called pre-funded warrants and Series A and Series B warrants. The deal was for new shares of common stock and these warrants. Warrants are like options. They give the holder the right to buy more shares later at a set price. They sold these in units. If you bought a share and its accompanying warrants, you paid $1.95. If you bought a pre-funded warrant and its accompanying warrants, you paid just a hair less at $1.9499, which basically means they want you to get in on this deal. Now, these warrants are interesting. The Series A and Series B warrants both have an exercise price of $1.7 per S-hair. That means if the company's stock price goes above $1.7, investors holding these warrants can buy shares at that $1.7 price, making a profit. The difference between Series A and Series B is how long they are good for. Series A warrants last for 5 years after a registration statement is effective, while Series B warrants have an 18-month lifespan. The pre-funded warrants are a bit different. They are exercisable immediately and have a super low exercise price of just $0.0001, which essentially means they are already paid for and can be exercised right away to get more stock. Now, here is where it gets a little tricky. There is a limit on how many shares an investor can own through these warrants. It is set at 4.99% of the company's outstanding shares. But here is the kicker: they can increase that limit to 9.99% if they give the company at least 61 days notice. This is a common feature to prevent an investor from gaining too much control too quickly, or to make the deal more attractive to certain investors. To make sure these investors can eventually sell the shares they get, Ascent Solar also agreed to file what is called a registration statement with the SEC. This is basically a public filing that allows the company's shares to be legally sold to the general public. They have to get this filed and declared effective within a tight time frame of 60 to 90 days depending on how the SEC reviews it. So what is the bottom line financially? After all the fees and expenses, Ascent Solar expects to bring in about $1.7 million from this private placement. That money is intended for working capital, and who helped put this deal together? H.C. Wainwright and Company LLC acted as the placement agent. For their services, Ascent Solar agreed to pay them a cash fee of 7% of the money raised and foot the bill for up to $85,000 in legal and other expenses. On top of that, they also issued warrants to the placement agent to purchase up to 71,795 shares of common stock. These placement agent warrants are priced at $2.4375 per S-hair and expire in 5 years. As part of this deal, Ascent Solar has also agreed not to issue more shares or file other registration statements for a period of 30 days after the main registration statement becomes effective. They're also restricted from doing any sort of variable rate transaction for a whole year after the registration statement is effective. This is to prevent actions that could dilute existing shareholders or create new forms of debt that could be a disadvantage. Now let's talk about how this sale was done. This private placement was conducted under an exemption from registration requirements. Specifically, they are relying on Section 4A2 of the Securities Act and Regulation D. What this means in simple terms is they sold these securities to a select group of investors who they believe are sophisticated enough to understand the risks without needing the full public registration process. This is common for private placements, but it means these securities are not registered under the Securities Act or state securities laws. To let the world know about this, Ascent Solar issued press releases on the 8th of December 2025 announcing both the private placement itself and the closing of the deal. These releases are attached as exhibits to this filing. The filing also includes a list of exhibits. These are the actual documents that make up the agreements we just discussed, like the securities purchase agreement, the registration rights agreement, and the forms of the various warrants. And finally, we have the signatures. This confirms that the company acknowledges the accuracy and completeness of the information provided. It is signed by Jin Zhou, the Chief Financial Officer, on the 8th of December 2025. Now let's see what we can make of this from a broader perspective. Ascent Solar Technologies is clearly in a situation where they need cash to operate. Raising $1.7 million is a positive step, but it is important to remember that this is not a massive sum for a company trying to grow or survive in the competitive solar industry. The fact that they are selling shares and warrants at these prices suggests they are willing to bring in new money even if it means diluting existing shareholders. The exercise price of $1.7 for the warrants means that for growth to be truly profitable for shareholders, the stock price needs to significantly surpass that level. The restrictions on issuing further stock and engaging in variable rate transactions are designed to protect the investors in this deal, and by extension offer some stability to existing shareholders in the short to medium term. Looking at the bigger picture, Ascent Solar has been around for a while and has been through various funding cycles. This latest move shows they are still in a growth or perhaps a survival phase. The success of this strategy hinges on their ability to execute their business plan and for the solar market to continue its upward trajectory. The risks here are obvious dilution for existing shareholders and the ever-present challenge of competing in a capital-intensive industry. The opportunity lies in the potential for the company to leverage this new capital to develop and deploy their technology more effectively and capture a larger market share. In conclusion, this 8K filing shows Ascent Solar Technologies is taking necessary steps to secure funding for its operations. While the amount raised is modest and the structure involves equity dilution, it is a clear signal of their immediate financial needs and their strategy to address them. Investors should watch closely to see how this capital is deployed and whether the company can achieve profitability and growth to justify these funding rounds. Alright, that is our breakdown of Ascent Solar Technologies' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord in the description. Thanks for watching. See you next time.